Everybody seems to be talking about inflation these days, but very few people understand what it actually is. In this video, I'm going to talk about the Austrian definition of inflation, how that differs from the common understanding, and why this matters to you as an investor. What most people understand to be inflation is just the idea of a general rise in prices. The most common way that this is measured is a statistic called the CPI, or the Consumer Price Index. What you need to know about this is that it is not an economic variable, it is a government statistic. As Austrians, we tend to be skeptical of government statistics. This graphic from Reddit investors shows exactly why we might be skeptical. It shows steel prices going up 145%, lumber up 126%, oil up 80%, soybeans up 71%. And what's the reported inflation, the CPI? 1%. So you can see there's kind of a disconnect here. So let's take a look at what the CPI actually is. It is an average of prices of a mythical basket of goods. There's no real person who exactly has this basket of goods. What they try to do is look at what your average person spends on housing, on energy, on food. Then they will go out and choose different prices and put them together in this average price for the index. And that's where you get that reported 1% inflation, which is obviously ridiculous when we've seen how much prices of so many different things are going up. What are the problems with the CPI? How can there be this big disconnect? The first problem is that the whole idea of the CPI is flawed in the first place of how it's calculated. It's taking average prices of heterogeneous goods, different goods. So for instance, you've got a loaf of bread that costs $2 for one loaf of bread. And then let's say you've got a gallon of milk and it's $1 per gallon of milk. And what the CPI would do is it would have to add these two things, the $2 for the milk, $1 for the bread, add them together and divide by 2 to get an average. However, that idea of adding and dividing different things, bread and milk prices, is conceptually meaningless. A good Rothbard quote on this: "Thus, any concept of average price level involves adding or multiplying quantities of completely different units of goods, such as butter, hats, sugar, etc., and is therefore meaningless and illegitimate. Even pounds of sugar and pounds of butter cannot be added together because they are two different goods and their valuation is completely different." And this comes from Man, Economy, and the State. And you can see I've got Rothbard up here on my poster behind me. So that leads us to another problem with the CPI, which is determining what goods and what weights of these goods or services to put in the basket. This is where manipulation of the statistic comes into play, because what they typically do is overweight prices that have been going down and they underweight goods or services where the prices has been going up, which this tends to understate the actual inflation rate. By underweighting certain goods and overweighting other goods, they're able to hide the real effects of inflation. And one thing you need to think about with regards to inflation, you could have a completely stable price and you're actually still be getting hurt by inflation because you've missed out on what would have otherwise been a decrease in the price. Let's say Apple iPhones are getting better, productivity is increasing, things are getting more efficient. If there wasn't this manipulation of the money supply, those prices would be going down and you'd be seeing real savings. However, by increasing the money supply, the price level might stay the same. You're still losing out. You've got that foregone deflation that you would have experienced without the inflation, which is what we're going to talk about, the real definition of inflation soon. When you think about prices, you need to think about them as containing information. The two types of information they convey are monetary information. So what is the monetary effect on these prices, which is when they're messing with the money supply or suppressing interest rates. And there's also real information in prices, and real information might be increases in efficiency. Prices might be coming down, like TVs and certain technology. We see it becomes less expensive as it becomes less expensive to produce it. However, these all get obscured with the large amount of monetary interference we have by the Federal Reserve suppressing interest rates, which are the most important price in the economy. So now let's talk about the Austrian view of inflation. The Austrian definition of inflation is that inflation is the increase in the money supply. It is not an increase in prices. An increase in prices is the effect of real inflation, which is the increase in the money supply. And this is a very important point. For this, let's read a quote from Ludwig von Mises, what he had to say about this. Inflation, as this term was always used everywhere and especially in this country, means increasing the quantity of money and banknotes in circulation and the quantity of bank deposits subject to check. But people today use the term inflation to refer to the phenomenon that is an inevitable consequence of inflation. That is the tendency of all prices and wage rates to rise. The result of this deplorable confusion is that there is no term left to signify the cause of this rise in prices and wages. There is no longer any word available to signify the phenomenon that has been, up until now, called inflation. As you cannot talk about something that has no name, you cannot fight it. Those who pretend to fight inflation are in fact only fighting what is the inevitable consequence of inflation, rising prices. Their ventures are doomed to failure because they do not attack the root of the evil. They try to keep prices low while firmly committed to a policy of increasing the quantity of money that must necessarily make them soar. As long as this terminological confusion is not entirely wiped out, there cannot be any question of stopping inflation. So if there's one thing I wanted you to get from this video, it would be this idea that inflation is not in fact rising prices. Inflation is the increase in the money supply. So you can think of the disease as being inflation, increase in the money supply, and the symptom being rising prices. So it's the increase in the money supply that sets in motion a process which ends up resulting in rising prices. Now, there can be a lag to this. And as we saw during the great financial crisis, many Austrians were expecting hyperinflation, lots of inflation, and there were a lot of people that said they were wrong because we haven't seen it. Well, in fact, there has been inflation. It just hasn't shown up in certain consumer prices where some of us expected it. It showed up more in asset prices, the stock market, real estate, and it largely has been contained there until recently. So that's another important thing you need to understand, is that there is a lag effect. The money printing and increasing the bank reserves and the amounts that banks can lend, it does not immediately cause inflation, and there's a lag, and that depends on several factors. So far, most of it has been contained to asset prices, but most recently with the stimulus checks, it's getting into the hands of more consumers, and that's why we're starting to already see higher consumer price inflation. The other trouble with the idea that inflation is rising prices is that doesn't explain what is wrong with it, and it doesn't get us to the root cause. If you say inflation is rising prices, well, what's the cause of rising prices? It becomes circular. You say prices are rising because prices are rising. No, prices are rising because you increase the money supply. Austrians wouldn't have a problem with inflation if all it was an increase in the money supply that lifted all prices at the same time and people's wages rised exactly with inflation. If all prices were to rise at the exact same time and everyone received money at the exact same time, there wouldn't be a problem with it. But the problem with inflation is that it benefits certain people sooner. It has effects on some prices and not others. And this creates distortions in the market. Like I talked about before, prices convey information, and it creates winners and losers. It also diverts money away from the real wealth producers and savers to consumers. Another way that it creates distortions is that, for instance, by keeping interest rates low and flooding the system with money, unprofitable projects that would not normally be taken on are taken on. So this destroys real wealth. It also is the ultimate cause of the boom-bust cycle. Okay, so how does this knowledge about inflation help you? For one thing, it helps you to know that we already have inflation, because you have a lot of doubters out there saying, hey, where's this inflation you were talking about? Everyone said the money printing was caused inflation, but it hasn't happened yet. Well, with the proper definition of inflation, you know that we already have it. It's just a matter of time for those effects to come through the system and affect certain prices that are going to affect you. So having this knowledge helps you to be more prepared. Many people have been caught off guard in the past regarding inflation because of this exact reason. They're like, hey, where is it? Where is it? Well, in this Rothbard quote, talking about prior to the Great Depression in the 1920s, Rothbard wrote, "The fact that general prices were more or less stable during the 1920s told most economists that there was no inflationary threat, and therefore the events of the Great Depression caught them completely unaware." And I think that's where we are today as well, because we've been in a decreasing interest rate environment for the last 40 years, and most portfolios are not set up to handle inflation. And in fact, it's going to catch many people off guard and have many very negative consequences. By having this knowledge of this economic logic that we know the Fed just cannot keep printing money and keeping interest rates low without consequences eventually. There's many things that have saved the Fed from having worse consequences sooner. Certain deflationary forces that have counteracted and hidden a lot of the costs of the inflation. What we need to do now, armed with this knowledge, is prepare yourself for the inflation that is eventually coming. We don't know exactly how it's going to show up in the system. Every time it's different. In the 70s, we experienced stagflation, and that's what I expect we'll probably experience this time as well, because we're in a very low growth environment. A combination of low growth, higher interest rates, higher inflation is stagflation, and that's what it's looking to me like it's going to come. There's certain beneficiaries, or I wouldn't call them beneficiaries from inflation, but there's certain assets or prices that are going to be more sensitive to the inflation than others, and they're going to be impacted sooner. Other prices are not going to be, or you may see deflation in other prices that have already been inflated, like the real estate and stock market have already been inflated. If we start to see consumer prices and commodities rise in price, that can hurt profit margins, which can hurt the economy, which can hurt the stock market, which can hurt housing prices. So you need to think about how these things flow through the system, and you can't just assume that, oh, well, we're going to see inflation, so all the prices are going to go up, so I can, I'll go buy a house and finance it and pay it back with cheaper dollars. That's not necessarily a safe bet. What you want to do is look at history, look at as what has performed well during inflationary periods, during stagflationary periods. One of the things that I recommend is precious metals, gold and silver. In my next couple of videos, I'm going to be talking about where to protect yourself, basically. The stock market is not a safe haven, especially certain types of stocks. There are certain areas in the stock market and precious metals that I think will provide that protection. In my next couple of videos, I'm going to be talking a lot more about how you can protect your portfolio against inflation and even profit from the from this inflation that we haven't seen all the effects come through the system yet. If you'd like to learn more about these strategies and more about Austrian economics, please subscribe to my channel below, and thank you again for watching.